CV Q&A, which stands for Cash Value Question and Answers. So we received a recent email from someone who is a bit older, and here's his question. It read, "Hi, I am 74 years old. Would this still work for me?" Referring to a whole life insurance policy specifically designed for high cash value. And then he said, say that I bring a few $1 million to the table. So I saw that, I'm like, whoa. And then second, I'm like, okay, we get this quite a bit. In this particular case, I recognize the email address. This was someone I had spoke with a number of years ago, and he lives out west and he's got some oil investments. It is legitimate, just the timing is key here. So finally, it looks like things are going to work out for him where he's expecting to receive his investment coming back and the amount of money he thought, and he still wants to consider a whole life insurance policy. When him and I first connected, this was a number of years ago, he was under the age of 70. And it worked. Dividend rates are higher. So his question is, will this still work for me? And say I bring a big pile of cash. Specifically, what would it look like? So the amount we're going to look at here is $3 million total. That's the amount he wants to consider, not what he wants to do, what he wants to consider moving into a policy. So here, policy design is critical. Simply, if I'm working with that amount of money or any amount of money, but that lump sum going into a policy, how do I ensure I maximize the cash value and long-term death benefit? Very, very important here. Company selection, product selection is also going to be important, especially as I get older. So the premium, the older I grow, the more it makes sense to minimize that base premium period. When you look at every single case in respect to maximizing cash value and long-term death benefits, typically a minimum premium will always do the trick for you. So we minimized it as low as we could go, which in some examples is 10%, some a little bit less actually. You'll see exactly what I mean as we look at it here. I'm going to pull up the breakdown. But the goal is to maximize cash value because he's taking cash he has, he wants to move it into a life insurance policy for the core benefits, safe, better than a bank account, liquid, he can access it anytime he wants, and then it's got the tax advantage. Tax-free if he doesn't mech it out, cash it out with a gain, nothing like that. So he's very attracted to it. And the death benefit's important as well, especially in this particular situation. I mean, this is an asset transfer play where he can take $3 million of liquidity, cash, put it into a life insurance policy, and immediately leave north of $4 million income tax-free to his beneficiaries. So from a legacy standpoint and a death benefit play, there is a nice advantage there too. So here's the big thing, timing. Ideally, he'd like to do it, and I'd like to do it in 2021. Why I say that ideally in 2021 is what do we have going on? He's uncertain if he's going to be able to do it in 2021 or 2022, depends on the timing of the investment. So if you're in a similar situation to this with any amount of money, hey, I've got funds coming in, I think I like this, but I don't know exactly when I can start. What do we got going on? 7702 impact. So in a case like this, what an agent wants to do, so if you're in the business and you have clients like this or people in this position, I stress, do not try and pressure them or rush them in to the new product or the old product before this change occurs, because if they can't do it just because the funds aren't there yet and they get the sense you're trying to push them and pressure them, what do you think the likelihood of them coming back to you when they're actually ready to move forward with a policy are? They still might come back, but they might go shop as well because people do not like that uncomfortable pressure situation, especially when things are outside of their control. So what we're going to do in this example is look at the impact. If this was me, what I would want to see is first, what is the most optimal policy design? So minimizing that premium, maximizing the PUA rider, that will do the trick. You're going to see the numbers here. So how do I optimize that? Number of years. I'll just tell you the number of years. At that age, it made sense to spread it out a bit more. 6 years is key. But I want to see both. Show me the product pre-7702 changes with the higher guaranteed rate of 4%, and then also post-7702 changes. And what do we have here? Guaranteed rate of 4% versus 3%. Also, you've got a higher PUA fee with the new product, with the option we're going to look at here, which means the upfront values won't be quite as strong. Now, aside from cash value, what was the big impact with this 7702 change? Mech limits and death benefits. The new product typically gets us less death benefit. With, not the exception, but with the interesting point that the older we grow, the less of an impact it actually has. So you'll see that as we look at the numbers. Let's first look at the design. So if this is you, and you're saying, okay, I'm looking at a large amount of money, could be any dollar figure, I want to make sure that it's set up properly. This is my money going into a policy. I don't want to find out after the fact that things weren't set up right. So how do I identify these stereo instructions? So 74 years old, second best health class, regular preferred. He's healthy, got a couple minor issues, but we ran the second best class in this issue. Healthy last I spoke with him. Here's what I want to touch on. Total payment is what? $500,000. Where's the minimum premium? Money can go where? Toward the premium or toward the PUA component? There's your premium. A little bit less than 10%. So this particular company, this is Guardian by the way, they will allow you to 10x your base premium in PUAs as far as a maximum payment per year if you wanted to. Now if you go 9x, 10x, or 10x, or 11x, whatever it might be, doesn't make a huge difference. When you grow older, it does with a short pay like this. But here's really what I want to emphasize. If you do the math here, this is not a clean 11x. Aside from the premium and PUA limitations, there's another issue here. Let's see if we can capture it all, which we can. So if I may direct your attention to the far right-hand corner where it reads net death benefit. Death benefit's $4.5 million. Now this is a product thing. All companies and products have different options. Here's your whole life piece, and then here's your term rider. And yes, we are using a term insurance rider for someone in their 70s. Here's the cost for the term rider. Almost 14 grand in the first year. This is the old product. Still with the guaranteed rate of 4%. So the true minimum would be what? 46 plus, call it the $14,000 term cost. What I will state, guaranteed and non-guaranteed values. That term cost may seem high relative to the amount. It's actually not. This is by far, when you crunch the numbers and run a comparison, in his best interest to have this term rider still attached in this particular scenario, because he's got the lump sum of money, the $3 million, funding it for 6 years, 7 years or less, then he's done. If it's 7 years or less, you remove the term rider after year 7 anyway in a max cash value design. So as we look at this guy, what do we notice? A lot of columns. There's your premium. There's your total out of pocket. So his total amount was how much? $3 million. Spread it out over 6 years. At that age, why I did that, that was the sweet spot. You have this balance to know, okay, do I just make the entire lump sum payment up front? The answer in that particular case is no. The reason why is no matter what you do with the policy, this base premium is going to be due for 7 years. So what that means is if you are not paying it, like what we see here, in year 7, you've got a $46,000 premium due and the cost of the term, your out of pocket is 0. So what that means, your cash value over here still goes up, which is fantastic, but the policy is paying for the cost of insurance, the base premium and term cost through dividends and interest. It's internally funding itself. So what's important to be aware of here, just from a lump sum funding scenario, is if I make the full payment up front, what that's going to require is the policy now has to pay for itself for a number of years. So depending on my age, it often makes sense to spread the payments out. If I'm older, 5 or 6 years. If I'm 40, it might make sense to do it over 4 years, something like that. And we've got other content on that. But in this particular case, it made the most sense to fund it for 5 years. This allowed, or only required 1 year, where it had to pay for itself through dividends and interest, which gave him a nice advantage here. By this point in time, just the rate it's compounding covered that premium no problem. Even when you look at the guarantees, you're still in a good position. So there's my cash value, breakdown of the illustration, and exactly where the money is going. Okay, now let's look at a comparison. What we ran here at the comparison sheet, and what we're going to look at here is the same product with two options. So same product with two options. What I mean when I say that is we have the standard dividend rate, and then also their indexed feature. Now, why I say the same product is when you start a policy with a basic dividend, if you're in a state that approves the indexed feature, you can go back and forth over time. I can attach the indexed feature, put it at 0%, never costs me a dime. I've got a basic dividend paying whole life insurance policy. But if I ever want to turn this on and have my cash value linked to the S&P 500 index, it is a good option just to be aware of. Some people like it, some people don't, but from an awareness standpoint, it's fantastic. Here's the 500 per year for 6 years. This matches the illustration. Breaks even between years 5 and 6. Keep in mind, this is for a 74-year-old. Not the best class health rating by any means. Breaking even between years 5 and 6 based on the basic dividend assumption. So often, have you ever heard or have you ever thought, I'm too old for a whole life insurance policy? There's no way it can work. It's going to be expensive. If you're price shopping and saying, I just want $1 million death benefit, what does it cost me? That'll often be the case. The older we grow, the more expensive it becomes. However, if your goal is maximizing cash value, maximizing the long-term death benefit, and you say, okay, here's how much I'm going to pay in, or here are my goals, what can you do with the policy design to the agent? Here's what you get. My point here, or the way how I would answer that question is we can customize the policy by going back to the whiteboard demonstration, reducing the premium, pumping more money into PUAs, growing the cash value. This gives you more of a living benefit, which you have access to anytime you want. And then here's your death benefit. Look at that. So here's really what was appealing. He moves in $3 million that came from an investment to just cash. And there's his death benefit that is paid 100% income tax-free to his beneficiaries. The IRR represents the net growth rate year over year after all the insurance expenses, fees, everything. What is it actually growing by? First year, it's negative. The main reason why it's negative, what does not show up in cash value, is that premium, which was the $45,000 and change, and also the cost of the term rider. That's the hit. Beginning year 2, the premium comes back. You're capturing just about everything. Term cost is causing a little bit of drag, but then you start picking up the pace, compound interest, all that good stuff, and the cash value grows over time. Then here, indexed feature, same exact thing, just better values because we're using an indexed assumption, which is good to look at, but I mean, personally, I like to look at things more conservative and progress from there. Let's look at the 7702 update. So if he said, hey, I can't start right now, things just didn't work out. 2022 is when it's going to happen. Maybe it's 2025, depending on timing and such. If that's the case, well, here we go. What we did here was optimize the same $3 million lump sum going into a cash value life insurance policy. I want to optimize that, meaning I want to minimize the death benefit. The death benefit, $4.15 million, gives him a MEC limit of guess how much? $500K. If you go back to the guaranteed rate of 4%, the old product, we had a death benefit of how much? $4.5 million. Based on the old guarantees and the old MEC laws, he had a MEC limit of $500,000. So in both models, we solved for the minimum amount of life insurance in order to maximize the cash value. Now with the new change with this particular company, we've got a higher PUA fee, which is why we have more of a hit up front. It's almost a negative 20% hit, meaning I pay in $500,000 in the first year and I have $400,000. As the years pass, it gets better and better, breaks even here. Between years 6 and 7, based on the present dividend rate, Indexed feature, between 5 and 6 a year better. With the new product, weaker upfront due to the higher PUA fee, but with the restructure of the pricing, lower insurance expenses, it has greater long-term potential, not greater long-term cash values. Potential. Can refer to any of our 7702 videos for that, just to be transparent. I like them all, but I don't like when people brush over details. So, side by side, we see exactly how it works. IRR definitely does have more potential with the new product. Look at that on the right with the indexed feature. A lot of potential, but again, it's indexed. Anyway, I hope that this video was helpful and answered some of the questions. So to answer his question, would this still work for me? The answer is yes, especially with the amount he's looking at. And by the way, you can slice a 0 off 2, and it'll be the exact same thing, just scale everything down to 10%. Did I bring this much? So I just answered that question. Yes, it would work without that amount of money, or any amount of money really. We'll always aim to maximize the cash value. That's the case if someone's paying in $3 million or $3,000. Like, it's always the same thing from a ratio standpoint. Granted, there's minimums and maximums. Still, it's good just to have the awareness and be treated the same regardless of the dollar amount going in. So I hope you enjoyed this one. Please reach out if you have any questions at all, and we'll talk to you soon. Thanks so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.